Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're peeling back the layers on a micro-cap ticker that's caught our attention due to its extreme cost to borrow, GITS. Now, before we get into the details, a quick but crucial reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about GITS. This is a microcap company, and as we often see with stocks of this size, data can sometimes be a bit more challenging to pin down. While specific sector information for GITS isn't widely detailed, its microcap status immediately tells us we're looking at a smaller, potentially less liquid company. This is a critical point to remember when we discuss its hard-to-borrow status. Our data shows GITS has an estimated float of just 2.4 million shares. That's a relatively tiny amount, which can significantly amplify price movements if interest suddenly surges. Show GITS ticker. What is cost to borrow and why it matters? So, what exactly does cost to borrow mean, and why is it so important for short squeeze analysis? When you short a stock, you're essentially borrowing shares from a broker to sell them, hoping to buy them back later at a lower price for profit. To borrow those shares, you have to pay a fee, much like paying interest on a loan. This is the cost to borrow, or CTB. It's usually expressed as an annualized percentage. Short definition text, a high CTB means that there's a strong demand to short the stock, but a very limited supply of shares available to lend out. Think of it like renting a rare item. If everyone wants it, and only a few are available, the rental fee goes way up. If that fee exceeds 100% annually, it means short sellers are paying more than the stock's value each year just to maintain their short position. This creates immense pressure. Why the stock is hard to borrow right now. Now, let's look at GITS specifically. Our screener flagged GITS because its annualized cost to borrow fee is an astonishing 932.3%. Highlight CTB, that is an extremely high number, signaling that it is incredibly expensive and difficult to find shares of GITS to short right now. We currently show an unknown number of shares available to borrow, which often means the supply is practically non-existent or extremely volatile. This high CTB, combined with its small estimated float of 2.4 million shares, tells us that if there are significant short positions, the existing supply of shares could be very constrained. However, we need to balance this with the recent trading activity. GITS has seen 0.0% change today, 0.0% over the last 5 days, and 0.0% over the last 30 days. Volume-wise, today's volume is 0 shares, with a 30-day average volume also at 0 shares, resulting in a relative volume of 0x average. This means the stock has been extremely illiquid, or perhaps has seen no trading activity at all for a period. A high CTB in such a low volume environment suggests that while it's hard to borrow, there might not be active trading driving price action. Squeeze mechanics explained. So, how does a short squeeze work, especially with a stock like GITS? A short squeeze occurs when the price of a stock that a lot of people have bet against starts to rise. As the price goes up, short sellers, who profit when the price falls, start to lose money. If the losses become too great, or if the cost to borrow becomes unbearable, these short sellers are forced to cover their positions. Covering means buying back the shares they originally sold short. Show animation of short squeeze. This forced buying creates even more demand for the stock, pushing the price even higher, which then forces more short sellers to cover, creating a chain reaction of squeeze. For GITS, with its 932.3% CTB and tiny 2.4 million share float, if significant short interest exists and trading volume ever picks up, the potential for rapid price movements from covering could theoretically be explosive. Our internal composite squeeze score for GITS currently sits at 42.5 out of 100, indicating it is some of the underlying characteristics, but the lack of volume is a major factor. Dilution risk check. One of the biggest silent killers of a short squeeze thesis is dilution. Dilution happens when a company issues new shares, increasing the total number of shares outstanding. This typically lowers the value of existing shares and can flood the market with new shares that short sellers can use to cover their positions, thereby negating any upward pressure from a squeeze. We always check for this. For GITS, we found no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B in the last 90 days. We also found no recent reverse split for GITS in our look-back window. This is a positive sign for the short squeeze thesis, as it suggests the company hasn't recently added a new supply of shares that could be used to thwart a potential squeeze or reduce share price through a reverse split. Let's take a brief moment for that important reminder again. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For GITS, given the unique situation of an extremely high cost to borrow and zero trading volume, the primary thing to watch for is a sudden increase in volume. Without volume, even the highest CTB won't generate a squeeze. It's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish outlook and are willing to pay exorbitant fees to maintain their positions, perhaps believing the stock will eventually trade much lower if and when liquidity returns. We also need to see if the available shares to borrow remain scarce. Any sudden influx of borrowable shares could reduce the CTB and ease pressure on short sellers. To volume chart, the microcap nature of GITS also means it's inherently more volatile and less predictable. GITS presents a fascinating case with its staggering 932.3% annualized cost to borrow fee and an extremely limited estimated float of 2.4 million shares. These are indeed textbook indicators of a hard to borrow stock. However, the complete lack of recent trading volume, with 0 shares traded and 0.0% price movement, makes this a very unusual setup. While the high CTB indicates immense pressure for short sellers should the stock become active, the current liquidity is a significant factor to consider. No recent dilution or reverse split filings offer a clear path on that front, but the real trigger here would be a sudden re-engagement by the market. Keep your eyes on GITS, but always remember to approach these high-risk, high-reward situations with extreme caution and thorough personal research. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analyses of hard-to-borrow stocks, and let us know in the comments what other tickers you'd like us to investigate. Thanks for watching, and we'll see you in the next one.